Good evening. It's October 20, Thursday, 6:57 p.m. This is Mark Yu,
And Wawi Santos.
and welcome to Mark Yu and Wawi Show, episode 59, Retail Bailing Out. So just a disclosure, me and Wawi are both market participants. We invest in the stock market, and we both work in the medical field here in the U.S. So on a weekly basis, we record once a week and tackle some of the issues in the stock market, at least for the layman investor. So off we go. So we usually tackle weekly sentiments, take a look at the if whether investors are thinking the stock market will go up or down. Well, we missed last week's recording, so last week was a little more bearish compared to, well, actually last week and this week as of yesterday, both for October 12 and October 19th survey, according to American Association of Individual Investors. Bullish sentiment is still way under the historical average. Now we're at 22.6 compared to 20.4 last week. So a little increase in bullish sentiments, but definitely still on the negative side of things. Bearish investors are 56.2 as of yesterday. 56.2% of the surveyed individuals think the stock market will be down compared to last week's 55.9. So heavily still heavily on the negative side or bearish side of things. The volatility index, as me and Wawi would take a look at. So this kind of like is a gauge whether there's been a volatile or up and down rocky ride in the stock market for past at least for the past weekend. It's been down relatively 4.2%. Despite that, the market actually is down as well for the week, right, Wawi?
Yes, it's been down. Today, the only thing, the survivors today is communication services with energy,
Mm-hmm.
those two sectors.
Wow, that's pretty interesting. Yeah, so for the past week, we have at least three sectors in the green. Energy sector, which comprises of heavily in oil industries like Exxon, Chevron, followed by communication services, which are the Google, Facebook, technology as well. Barely made it to green, 0.74. And each and every sector for the past week, besides those three, are in the red, led by consumer cyclical, down 1.78%. And for the past month, I'm noticing some trend here, Wowie. Only one sector is in the green for the past 4 weeks. Energy, 7.2%. And the rest, healthcare, basic materials, real estate, utilities, down in deep red territory. So, for those who are not aware, utilities are like the safe haven, as one might put it, because of their reliability and income. Like a household would need utility to survive. Water bills, water utility, electrical utility. But despite its security, it's actually the biggest loser for the past 4 weeks. One might think, like I'm thinking here, is because of the rising interest rates, utilities are much more in the bind. They are hooked into paying more for interest because these companies are heavily in debt, and that with rising rates, it doesn't favor them as much because of the rising interest rates, and it kind of like affects their financial performance or integrity overall. Would you agree with that, Wawi? Or
Yeah, I agree. Energy is the only sector that's thriving in this type of bear market where you have the inflation
mm-hmm.
and volatility. But traditionally, when there's inflation, you know, financials would be another place for investors to go. But um, we're not seeing that right now.
True. Yep.
Um,
Financials is also down for the past month, down 3.38%. So it's not been that safe haven. I know what you're referring to, Wowie, as well, because the big banks just came out with their earnings, and Bank of America definitely paint a really nice picture. I think they generated nearly 7 billion in income
yeah,
because of the rising rates. So it has done them good. They can now collect more interests for consumer services. And I think for the past couple of episodes, me and Wawi have shared a chart, which we're gonna share some more in this episode. But previously we shared a chart where consumers are now kind of like dipping really much into their savings or which whatever is left of it, but much more so on taking more credit card debt, which is now fueling, they're supporting the overall spending. So more consumer debt, more credit card debt results into more income for the banks now that the interest rates are climbing steadily.
true. Yeah, that's very true.
Mm-hmm.
But in any typical business cycle, when it comes to recession, energy is usually the winner, followed by healthcare and consumer staples. But what we're seeing right now is, if things are trending towards, electrifying almost everything, cars and, different types of modes of transport, they're seeing that copper, there would be a high demand for materials, especially copper,
Mm-hmm.
for those conduits and infrastructure upgrades that the energy sector will need.
Mm-hmm. That might be ways to go at this point in time because I think also as well, Wami, that with the economic slowdown that the CEOs and most of these companies are projecting broadly, it might still hamper down the demand for Dr. Copper.
Yeah, yeah, that's
Mhm.
true for, for the near term, but looking at the potential, that's something to look for in the material sector.
Right. And for our fear and greed index, so right now we're at fear, whereas a week ago we were actually at extreme fear at 24. So we bounced to 40 points as of now compared to last week's 24. And if you're going to look at the general timeline, it seems that we're still definitely on the less optimistic side of things. Market momentum as well, where we take a look at the S&P 500 and its 125-day moving average. We're still on the bearish side of things. We're still trending down, negative momentum. And for the stock price strength, a few big stocks can skew returns for the market, but at this point in time, net new 52-week highs and lows, we're definitely netting still new 1 year lows overall for the stock market. The McClellan volume, which suggests the investors' activity, if they're buying or selling, definitely they've been like selling at this point in time, which we're gonna see too in the fund flow section just a few more seconds from now. The put call options definitely still investors buying more put options, meaning that they're trying to protect their portfolio against any dip or any further downtrend in the overall stock market. So put if you're buying a put option, it means that you're protecting your portfolio from a downside. If the market generally goes down, you kind of gain some profit after buying a put option. And the reverse is for the call option. So if we're gonna take a look at the fund flows, so this is according to Reuters, and this was published about 6 days ago. They do this on a weekly basis. So this is entitled Global Equity and Bond Funds See Outflows for Eighth Consecutive or Successive Week. So investors have been dumping both stock and bond funds globally.
Mhm.
So it's not been quite a a relief Thus, our title of this episode: Investors are still dumping everything that they can, both in stocks and bond funds. 7.3 billion worth in stocks being dumped, and more than twice, 14.27 billion worth of bond funds being sold worldwide. So we're seeing interest rates further climbing up, which is indicative that the Federal Reserve's strategy of financial tightening is working. So here's another graph which is very helpful. This is from Financial Times. So investors are now dumping a lot of stocks and bonds, but they're throwing it more into the money market funds. So money market is like a temporary place where you could park your money for a certain amount of interest for a certain period of time. So this indicates that the stock or the investors worldwide are just throwing it all into some safe haven right now, which is, actually kind of represents a dry powder. So not only retail investors, if you take a look at this, but also institutional, like big money funds, also throwing it in the money market. So that's one
De-
thing to look at it. Mhm.
Definitely cautious and waiting. They're just anticipating a pivot from the Fed, which likely may happen next year.
Yes. I think Jamie Dimon of JP Morgan kind of joined the gurus out there predicting that the US will enter recession definitely within the next 12 months. So it's something to watch out for because right now we're actually suffering the worst performance of the stock market in history. One of the worst, I think third worst ever.
Yeah.
Um,
I'm, technically, I really believe we suffered a recession
mhm.
June of this year, but this will put us in a recessionary um, position, because of this um, aggressive. Well, I can call it, relatively aggressive. I think they might be more aggressive if they don't see, the indicators trending down. But a lot of analysts are in a consensus. 85% of them now are predicting a recession by next year.
Right. In a recent Bloomberg survey, points to nearly 100% probability. So this is a chart from the Federal Reserve themselves. So if we're going to take a look at it, this is the financial conditions. We've been from time to time we've been sharing this chart since last year, and you could definitely tell from last year July, it just slowly crept up, and now we're close to zero mark from negative 0.7 territory last year when we were still hitting fresh new all-time high stock market bull run last year till late last year. Now we're suffering like increasing tightness because of the Federal Reserve interest rate hikes. And and for those guys who are newly tuned in, we are now including this dumb money confidence chart. So which is interesting. So the makers of this chart didn't really intend to call it that way, less dumb money, but it kind of shows like what is the overall sentiment of those investors. So if when optimism gets very high, this dumb money index goes high as well. So and what's beautiful in this chart is they're comparing it side by side with the S&P 500, which is the broader stock market index. So if we zoom into the past year, the dumb money is actually trending low for the past 12 months. But I think it's better to view it in a longer term, like 5 years. Now we're definitely going to see back in March 30, when everything was selling off 2020. This was during the lockdown days. The dumb money confidence went really low. And that was when the market bottomed. And now that we're seeing correction and then the bear market, we've seen that the dumb money has actually touched 0.27, whereas back in March COVID lockdown, it was as low as 0.21. So why we're looking at this? My speculation is we have yet to see the bottom if the stock market is yet to go down even further. So this is until September. Maybe we can advance this to October 2022. Oh, there we go. You see? Wow, that's really good. So let's do the 5 year. Yeah. If we're gonna take a look at the 5 year average, we have yet to see the lowest of low of dumb money index compared to its recent history. But if we're gonna click the all, like history wise, since 2002, since this chart has been concepted, yep, we're still barely there at the lowest point of the dumb money confidence. So nonetheless, I think while it's a case to case basis. Bloomberg as well have been highlighting how bearish investors are getting at. One article that was published yesterday, dark pool index shows epic bearishness among retail traders.
Mm-hmm.
So investors are definitely this is the chart that they're referring to. This is their squeeze uh metric as pointed by Bloomberg. So it's quite technical here. But if we're gonna do the 6 month trend, the green is the S&P 500, while the DIX is the squeeze metric. So according to them, the idea that buying the dip has failed, and it sure looks like it. But maybe the stock market can languish for a little while. In the meantime, yeah, people are still on the bearish side of things. So it's just one of those indicators showing that you know investors are getting still on the bearish side of things, which is as we have found in the AAII, or American Association of Individual Investors Sentiment Survey, that investors are really on the bearish side of things. Come to think of it, it should be, as long-term investors, this may be like a good time actually to start buying some more if you have the funds and you have the capacity to do so, right, Wawi?
I would agree. Yes, definitely showing some opportunities here
Mm-hmm.
since we're seeing the near real valuation of some of these companies. Even the large cap companies are going to a getting to a very good attractive valuations.
Mm-hmm.
Um,
I think Google now is priced as $99 a share, whereas it was as high as $140 at one point. Um,
exactly.
Apple now at 140 bucks. It was at 170 just a few months ago. So it's good to start nibbling in, I would say, right, Wawi? Start
Yes, when
adding more.
yeah,
Don't panic.
typically when you see the consumer sentiments trending down, you will see an uptrend, but it's just an up and down movement on the prices is what you're seeing. But once it reaches bottom, it's gonna go up.
Right. So
um
as you've said, the survey of consumers, they came out recently. The definitely, if you look at the chart, it's way down there, but it's slowly bouncing up. It's now at 59.8 compared to September's 58.6. So, one way or the other, consumer sentiment is rising somehow, and probably this kind of helps, you know, give some relief in the overall stock market sentiment.
It's all hinging on the Fed movement,
Hmm.
but it's rather um, paradoxical because no matter what they do, inflation still goes up, and jobless claims, recently
Mm.
just went down another 12,000 from last month. And we're still not getting the job effects. And even in manufacturing is ramping up, even
Hmm.
though there's inflation going on.
Right. So
Um,
somehow a very resilient economy, despite that the Fed is hiking up rates. I think most companies have still cash money on their banks. Referring to companies, not the consumers.
yeah, so without the Fed tightening, I think we would have had a dangerously high inflation with a rapidly bullish economy
Hmm.
that can go haywire.
True.
So it's a balancing act, and people are just complaining that this hawkishness by the Fed will lead us into a recession.
Mm.
Hopefully, it's going to be brief. But one thing that we have to look at is how much interest the U.S. government will have to pay for uh, the 30 trillion debt that
Mm.
the country has incurred.
True.
Um, and that will have to come out of a budget somewhere.
Yep.
And
Probably higher taxes down the road, which isn't good. So
yeah,
borrowing from the future.
yeah, we are borrowing from the future. But looking at historical trend after midterm elections, usually the market trends up. So
Hmm.
I don't know. We'll see.
Yep. And here's a chart from no other than the what we have been following closely. Morgan Stanley's chief investment officer, Mike Wilson. This is actually a chart from Bloomberg. So if Morgan Stanley's, well, this guy has been correct all year long since last year, calling the shots that the stock market will go down. If he's gonna be succeeding on this call, we have yet to see the bottom in the market. He sees the market will bottom, the S&P 500 will bottom at 3,000. So as of today's close, we are actually somewhere in 3,600 at this point in time. So that's quite a drop. 665 points from here would mean that we have yet to see 22% loss from this point in time just to see the market bottom. I think at that point in time, it'll be pure suffering from each and every investor who have stayed, invested in the stock market.
Definitely going to be painful for a lot of investors, but I am still investing, and I think this is offers us a lot of opportunities to look for bargains.
Right. And now we're taking a look at some charts from Yardeni. So he freely provides these charts. These are just valuations for the S&P 500 as a whole. Currently, as of let's see which date. As of yesterday, October 19th, he updated this chart. The S&P 500 large cap, it's trading at a forward price to earnings valuation of 15.6. So this is quite a drop from around 22, 23 back on the highs of last year. So look at the small cap valuation. Oh my. So all the way from 26, 27 times earnings, they're now down to near 11. So that was huge drop in terms of their valuations.
And there's where you find your bargains.
Hmm. The small cap. And I think I've
Mm-hmm.
seen a publication just a few days ago that actually the market is favoring some of the small cap comeback just because of the, it's immunity, not immunity, but it's exception, because most of these small cap or small companies, they only do business here in the United States, and they're much less affected by the stronger dollar in terms of their bottom line. So that's one way to think of it if you're trying to avoid any unnecessary pain uh, in terms of being affected by the stronger US dollar, because the US dollar is now at its strongest for the past several decades. So now we're looking at the S&P 500 revenue expectations or forecasts. So you could definitely tell in 2020 the COVID lockdown struck, boom, a big dip in its growth in terms of revenue, negative 2.8%. 2021 came and all the stimulus, spending
Mm-hmm.
arrived. So we registered quite a bonanza back in 2021, 16.2% increase in sales. And then 2022, we're seeing a slowdown, back to 11.9% growth. And then in 2023, you could see there's a decline in sales growth. And for earnings, some of these earnings are now being forecasted. So, like similar to 2020 performance, we saw 14% drop in 2020, 2021 50.5% rise, 2022 8.7%. So why am I pointing this out? This is because Morgan Stanley is saying that we're now going to see a drop in profits among S&P 500 companies and most publicly listed companies, resulting in further sell-off in the overall stock market. So looks like we're down to the wire while we have 10 minutes left on our recording. So
Mm-hmm.
it's good to just take note of the recent earnings report that just came out, one of which is a Whirlpool. So as what we have just been talking about, Whirlpool cuts its earnings outlook after consumer demand drops massively. So this is one of the largest, if not largest, um, manufacturer out there. They manufacture mainly, household appliances, washer, dryer, refrigerators. So this company has said that, quote unquote, its CEO, Mark Bitzer, said in a Bloomberg interview, in particular in the US, we saw consumer sentiment dropping off massively in June and July. So they're seeing these challenges persist through first half of next year. So this is one thing to watch out for, because most of the Wall Street um, experts are also predicting a slowdown by that time of year next year. So that's on the manufacturing side, and we take a look at now at Snap, which is on the advertising side. So I think of Snap as a secondary advertising, a go-to place. Number one would be Google and Facebook. So Snap announces slowest sales growth ever. So as a result, its stock dropped more than 20% as of this time after this release. So it was once a high flyer sometime last year, but now it's down to drain. It's trading less than $10 a share at this point of time. Now it's at $7.87, down 27%. Whereas at one point last year, it was trading at exactly a year ago, it was at $75 a share. So it lost 86% of its value, Snapchat. So it's quite a dramatic fall from the top, as one would say.
Yeah,
Procter and Gamble. Go ahead, Wawi.
definitely a move from um, tangible assets. I mean, from intangible assets to tangible assets.
Mhm.
And now that we're moving to Procter and Gamble, you could see how
Uh-huh.
Procter and Gamble is doing versus these technology stocks.
Yeah, I think Procter and Gamble also came out with their report. Let's see. They topped their earnings expectations due to their pricing power. So they were able to at least enjoy a little bit of inflation plus their brand name. Um, Market received their reports quite okay. They didn't sell off. Their stock actually rose 1.67% after the release. I was wanting to see if we could pull up their report, but let's just take a look. Procter and Gamble. Here we go. Press release. So their sales are up 1.3% since last year, and their earnings are up or beats the expectations by at least 2 cents. So there we go. Actually, their diluted earnings are down 2.2%. So they didn't escape the increasing expenditures, but not terrible performance at all. They actually beat expectations. So profit bottom line is down 4% actually, from 4.1 billion to 3.9 billion dollars, but still relatively, safe compared to what we saw in Snapchat and Whirlpool expectations. Netflix also came out with their report, which is, quite a surprise. Finally, their earnings beat expectations. They finally gathered more subscribers, whereas they've been losing by the millions since the start of the year. Even Bill Ackman, a famous investor, lost a lot of money buying its stock back in February and then having to sell it on the second quarter report. So looks like somehow Netflix has find a bottom on their stock price. And actually, they were at as low as $200 a share at one point. Right now, they're at $268 a share. So some comeback there from one of the original tech or FANG stocks, as we call them. And Tesla as well came out, and yeah, as you've pointed it out, while they're now at their 1 year low as a result.
Yes. Hmm.
But I think somehow at some point they still delivered their highest delivery figures since their inception.
Yeah,
So
they did. Um, Hampered down by the COVID lockdown in Shanghai and the new setup in their new factories in Austin and Giga Berlin. It's still a growth company to be tested
mhm,
regarding its demand now that it has more competitors: GM, Ford, Kia, Hyundai, Toyota,
right.
Volkswagen coming up with their consumer EVs.
Hmm. And you could still see here the revenue overall sales is still up 56% since last year. I mean, that's tremendous growth despite that we're actually in a, recession or a slowdown in the overall economy. And their profit, look at that. It's still up 103%. So
And
nearly double as last year. Hmm.
potential for profit might be higher next year if the demand still is true for Tesla vehicles, because they're gonna get the $7,500 EV credit again starting January of next year. So
Interesting.
something to check out.
Yep. And another random chart that we're going to include in this recording is the CEO confidence among CEOs here in the US. So if we were to take a look at this chart, it is even at its lowest, even lower compared to the COVID lockdown days. So a lot of CEOs are ringing the bell, including JP Morgan's for sure. He once said that there's a hurricane on the horizon. So I think it's just only a matter of time that we see some of that reflect in the earnings. So for the COVID billionaires, so net worth of some of the CEOs that got rich and now, you know, as a result of the recent sell-off in the stock market, suffered negative changes in their net worth. So Moderna CEO saw his net worth down 75%, Zoom CEO down 84%. Some of these companies are Coupang, Korea's Amazon also lost quite a huge amount. So I guess it's only a matter of time that we would see some more earnings results. But I guess we have to cut our recording at this juncture. Thank you guys for listening and tuning in. Again, this is Mark Hughes signing out.
Wawi Santos signing out.